Welcome back to another exciting episode of Citi Market Watch. The goal of the series is to give you meaningful updates on the market and how this impacts your investment strategies and portfolios. Incredibly happy again to have Audrey join us as we explore the world of commodities. Audrey, it seems like in the blink of an eye, the entire commodity landscape has changed. Copper is trading at almost $10,000 per ton, and energy, or Brent crude oil, is around $70 per barrel, which are multi-year and decade highs. And the outlook continues to look extremely robust.
Exactly. Now, things are moving fast in commodities as so many realities are converging. But the fundamental backdrop has simply been that commodities have been starved of capital or investments for so many years, almost a decade and a half. Now, the last time we saw such a commodity boom was in the early 2000s when China was investing heavily in its economy. Since then, we have seen the majority of investment dollars chase technology returns like the FANGs, leaving very little for commodities. There has been no investments in new supply, minimal capital expenditures, and then when it was least expected, along came COVID-19. And finally, the icing on the cake, ESG. Now, we started 2021 with almost every single commodity market in deficit, demand far outstripping supply. Essentially, commodities benefit from three major macro themes: recovery, reflation, and decarbonisation. And whilst this commodity boom feels inflation risk, as we have talked about in previous episodes, there is a silver lining. Can you tell us more?
Well, the silver lining really stems from understanding the core underlying drivers to this commodity resurgence. Post-pandemic, we are seeing a big global synchronized reflation as countries and economies around the world look to reopen with aggressive vaccination programs and policy support. Notable, of course, are the multi-billion and trillion-dollar efforts from the European Union, China, and especially the US. But Audrey, what is different is that this isn't another round of central bank bond buying or asset purchases like we saw post-2008. This is a global phenomenon, and policy efforts here have been largely focused on getting money to individuals everywhere. We are seeing this in the US, where physical checks are being mailed out to every eligible US household or credited directly to their accounts, and in China with multiple significant tax breaks and subsidies. This effort is what is driving the grassroots broad-based rebound we are seeing in activity, and is also the most significant effort in redistributing income in half a century.
So, is this just a repeat of the commodity boom we experienced with China in the early 2000s?
I'm glad you brought that up. In many ways, what we are seeing is bigger than that. Aside from all the reflationary and normalization efforts, we are for the first time seeing alignment across all the major governments with policy to support decarbonization goals. The investments needed across all the sectors and industries to achieve this will be multiples of what we saw with China in the 2000s. As we have seen and are seeing from the specific European, Chinese, and US policy initiatives, the focus on green infrastructure is a key driver of commodity demand and prices. Audrey, why is this the case?
Well, aside from the breaking recent news of the US-China climate agreement, which is critical because the US and China together account for close to 50% of global carbon dioxide emissions. Now, you cannot have a clean energy revolution or a global decarbonization effort without raw commodities like copper. Copper is the new oil. So this is one of those fun facts and did you know moments. Did you know that electric vehicles need 5 times the amount of copper as a normal internal combustion car? Did you know that wind energy drives 20% of all copper demand as it is used in turbine generators and cabling for wind farms? Did you know that approximately 18% of industrial silver is currently used for solar panels? And this reliance on raw commodities extends across the entire metal complex.
That's fascinating. A little bit counterintuitive at the same time, but I get it. So let me take stock for a moment. We are post-pandemic. Vaccines are getting rolled out globally. Policy support globally has been aggressive and historically unprecedented. which is driving synchronized global reflation. And now to add further tailwinds, we are also seeing coordinated green infrastructure initiatives, which fundamentally require a lot of raw commodities. Audrey, could you quantify a lot of raw commodities for us?
Well, Citi analysts expect a copper deficit over the next 5 years at around 500,000 tons per year. And other forecasts see this deficit running as large as 1 million tons per year.
Okay, but that's just a number. Can you give us a feel for how big that is?
And I am feeling like some Enrique Iglesias, but the word is escondida.
Escondida?
The Escondida mine is the world's largest copper mine in Chile, and it produces about 1 million tons of copper a year, or about 10% of the world's supply. So yes, this supply-demand imbalance is significant, and whilst we are just talking about copper, this is reflective or representative across all the base metals, and it is why we see prices high and rising.
And the problem compounds because, as we highlighted at the start, there has been no investment or capex to build supply. It typically takes 3 to 4 years to extend existing mines and 10 years or more to bring new mines to market. So Audrey, how should investors be thinking about commodities?
Commodities are cyclical, as many of our longer-term investors will know and have experienced. But the shift to renewable clean energy and sustainable circular economies is an overriding, unstoppable trend that is driving this commodity supercycle. So whilst prices are high and commodities are also inherently volatile, investors should see weakness as an opportunity and be very mindful about the supply constraints and the bias for prices to gravitate higher.
Thanks, Audrey. In addition, over the immediate short term, commodities are an inflation hedge. It probably goes without saying that when there is strong aggregate demand and inflation, this is precisely the time when commodities perform the best. Economic recovery is beneficial for all kinds of commodities. As inflation risks rise, bonds get sold and yields rise. And as we have seen, commodity allocations to date have been resilient. Lastly, on base metals, most investors typically also own mining equities. Mining companies, as with commodities in general, have been overlooked for so long. For years, management have paid down and reduced debt and now have strong, lean balance sheets. Valuations remain attractive, and mining companies continue to return capital through healthy dividends and buybacks. Audrey, do we have any thoughts on soft commodities?
Just a brief one. This is also a fascinating allocation, and we tend to think of it from a millennials trend perspective. Now, we see millennials, the current most influential demographic cohort, as extremely focused and concerned about climate change and decarbonisation. And this is also reflected in their buying decisions. That is, how food is consumed, where it is grown, how it is grown, is it local, is it organic, and how is it transported? Post-pandemic, for example, even here in Singapore, we have seen vertical farming flourish and blossom, and increasingly more restaurants are offering plant-based meats like Impossible Burgers. Soft commodity demand remains strong as economies open up, and where we see value is the shift towards consciousness or premiumization vertically within soft commodities.
Great, magical stuff, Audrey. This has been a real thought-provoking conversation. Thank you for tuning in for this episode of Citi Market Watch. Please contact your Citigold or Citigold Private Client Relationship Manager for more opportunities.